welcome to the session this morning. Ngā mihi nui, kia koutou katoa, warm greetings to you all. On behalf of the New Zealand Pacific Island chapter of the Risk and Insurance Management Society, or RIMS, delighted you could join us either in person here in the room at KPMG or online for this morning's session on risk insights. The first presentation that we have this morning is Connecting Strategy and Risk, and we'll be looking at how we use risk management as a tool to prioritise and allocate resources and key drivers and considerations for articulating the risk appetite. And presenting that this morning will be David Sutton from KPMG. Just as an introduction, David has extensive risk management experience across a broad range of organisations and sectors. He's been involved in risk management for over 20 years. Key passion for David is linking strategy of risk and making sure that's balanced between value and pursuing opportunities. He's a key facilitator for the Institute of Directors and has written a lot of the course material for the Audit and Risk Committee Essentials and Risk Essentials courses. So I'll hand it over to David. Thank you, David.
Thank you. Tēnā koutou katoa, ake mihi kia koutou katoa hui mai nei. He partner hau ki Tamaki Mokoro, ko David Sutton tōku ingoa. Ko te tumanako pai te haere e te hui nei, pareira tēnā koutou katoa. So good morning, everybody. Welcome to KPMG, and thanks for coming this morning. It's a pleasure to be able to speak this morning. So, yeah, I do a lot of risk work. Been at KPMG 10 years. Prior to that, Telecom, Fisher & Paykel, PwC. Pretty much all my time nowadays, I head up consulting, but all my time now is really facilitating risk discussions with boards and executive teams, particularly. So earlier this week with Te Ake Whaiora, the Māori Health Agency, trying to change equity for health outcomes in New Zealand. No small task, with an election on the horizon, which could seismically change their strategy moving forward. Previous to that, earlier this week, City Council talking through what they're going through and what their strategies are moving forward, through to forestry, through to banking, so all sorts of different types of organisations. And I guess, you know, if I boil it down to, you know, why talk about strategy and risk? Well, I think there's a few things in the back of my mind around risk which are problematic for us as risk professionals. The first is risk is often all downside, or perceived as all downside. You know, we turn up to an executive session to talk about risk, and they're like, "Oh my, the will to live." It escapes out the room, and people are wondering when it's going to be morning tea or lunchtime. So it's often downside, and yet, you know, this should be about upside. You know, the whole cliche risk and reward is very true. So, you know, how can we change the conversation, the dynamic from just around threats? Do we want to manage risk, which means not minimize it, it means take it. And actually, most conversations I have with boards are around taking more risk in certain areas rather than taking less risk. The second thing is connected to that, and that is around executive buy-in. Generally, boards are pretty bought into this whole process and philosophy around managing risk. Executives less so. Part of it is because we often see risk as downside, and so again, you know, we don't want to be the downer in the room. But also, you know, what they're thinking about is how do we deliver our strategy? What do we need to do? How aspirational are we? Where are we going as an organisation? So their risks, the way they think about risks, if we're not connected to strategy, are a little bit different to the way that we're thinking about it. And the third thing is around VUCA, volatility, uncertainty, complexity, ambiguity. And, you know, risk is complex. And, you know, to be honest, you know, I started doing risk back in the 90s. I know I don't look that old, but it's true. But, you know, our general approach to likelihood impact prioritising risk is pretty old. Hasn't changed an awful lot. And yet, you know, the world is complex and is getting more complex. So, you know, I talked to boards saying, look, risk is becoming more judgmental, less scientific. It's more about perspectives. It's less around methodology. But how can we try and get some methodologies to help simplify some of the complexities or explain some of the complexities that we've got from a risk point of view? So that's some of the concepts that I'll talk through today. None of it is rocket science, and apologies if this is talking about things that are readily apparent to you. But you know, they are things that I think can help in all of those three areas. So the first one, and this is I guess a model that we've adopted from the Institute of Directors when I started doing work with them, and it's really become the centrepiece of the work that we've been doing over the last 10 years actually. And this is about the connection between strategy and risk. And you know what this helps to be thinking about is, you know, if we're thinking about risk, the standard is pretty clear. It's risk to objectives. And yet every time we go in to talk to an organisation and look at their risk processes, it generally misses that key link, which is context and objectives. And generally all the conversations that we have with boards and executives is thinking about, well, where does strategy drive risk? So where are we aspirational? Where are we trying to do big things? Where are we doing things that are complex, hard? That is not risk-free. And yet the board are very willing to sign up with the executive to those very aspirational strategies. So if we're looking through doing digital transformation, you know, it'd be easier, right? We could de-risk. Why do it? You know, why do it when we've got to have the right people? We've got execution risk around that digital transformation. There's going to be money involved. We've got to balance that while we're managing our day-to-day business. My risk settings would be much lower if I just didn't do the transformation. But of course, then it's the risk of not doing the transformation. And then my risk changes to being a risk of disruption, which is really a downside risk. So how can we change that dialogue to being, okay, well, we actually need to take risk. But we need to understand that that's not bad risk, that's great risk. Still not certain we're going to achieve those objectives, but if we can think about, well, what are the key risks we're driving from here? There might be people, there might be all types of manner of risk. So often that side of the conversation at board and executives completely missing, and it can seismically change the conversation. Example earlier this week was around people. You know, the organisation had lots of downside threats, external risks, health and safety, through to change in government and policy. They're all risks from the other side, in actual fact. But they were missing things like people. You know, people are critical to their strategy, to set up relationships with third parties, to help to reorganise their systems. If we don't have the right people, the right capability, we don't have the good culture, that was completely missed off their profile. So a 2-minute discussion on strategy and where are they going and what's really important to support it from a risk point of view changed that conversation in a heartbeat. But we don't forget it from the other side. So, you know, I think sometimes there's a tendency at boards to go, we only want to focus on the strategic risks. So the operational risks, so we want to leave that to management. Well, look at all the catastrophic failures we've had. COVID, that was not a strategic risk. That was a pandemic that created risk contagion, which I'll talk about shortly. Fonterra, back with its food safety, false positive botulism product recall, that was a food safety operational risk. Telecom, when its mobile network fell over, that was a network continuity risk, partly strategic with its third party that helped to implement the network. But a lot of the times, these operational risks are strategic because they are material enough. And this is the other side of the coin. It's what are risks to the strategy? And I don't really care whether they're strategic, operational, financial, or compliance. All we care about is, if we think about risk from both sides of that coin, what are the most critical risks that the board and the executive team should be focusing on? So it's a very simple concept, but I find it's very helpful. Whenever we do risk work with boards and executive teams, we always start with strategy. And you know, what if you don't have a strategy? Well, that's quite common. But then the conversation becomes, well, what's your purpose? What are you here to do? Where are you heading in the next 2 to 3 years? What's hard in that strategy that drives uncertainty? And then the other side, what could push that strategy off track? So when we're thinking likelihood of impact, it's the likelihood of impact ultimately to the strategy, but we still get that balance of, you know, health and safety still can be material to a forestry company's strategy because they've licensed to operate. Business continuity will be material to your strategy because if you can't operate, you can't deliver a strategy. So we can actually connect very different types of risks within this context of this connection between strategy and risk. Heading on from there is around risk appetite, and we're probably doing more risk appetite work with boards and executive teams than we've ever done. We do it with both, and generally we'll work through with the executive first and then board, and that is because while it is the board's risk appetite and they are accountable for the delivery of the strategy, the executive team are responsible for delivering the strategy, and they have to manage these risks on a day-to-day basis. So we always get their perceptions of board risk appetite and talk about tensions and trade-offs between those two groups to get consensus. But when you're thinking about strategy and risk, strategy gives you the license to take risk and to have risk appetite. Without that connection, why would you want to have appetite for downside risk? So it's a good context to lead into the risk appetite discussions. And this is a model that we use with boards and executive teams, which is pretty simple, but it's what are some of the drivers that would be have you up taking risk versus not taking risk. And so we will be taking risk when there's significant opportunity or significant outcomes or complex outcomes that we want to achieve. If we handbrake the strategy and slow it down and make it too hard, well, we may miss those opportunities. So that may be a reason we've got appetite to move forward quickly with more uncertainty. It can be because the mitigations are unclear. And one framework that we talk a little bit about more nowadays is this Nevin framework, which is around problems and going from simple problems through to complicated, through to complex, up to chaotic. And, you know, in the old days, we'd go, well, we have a risk, we mitigate it, we're good. Well, that's not the case anymore. We don't know, particularly for complicated, complex and chaotic risks, we're not going to be sure if the mitigations are going to actually have any impact when we're talking about digital transformation, climate change. So we have to be open to the fact that we have more uncertainty because we don't, even best practice, what is best practice for complex risks or chaotic risk? We don't know. There is no best practice. It is giving it a go and taking a step forward, probably blowing some money, perhaps taking more time, perhaps not getting the outcomes you expected. So again, more and more, particularly at board level, executive level, the focus is on these complicated and complex and chaotic risks rather than the simpler risks. Perhaps health and safety is a simpler risk in some dimensions around physical risk, but when you get into mental health, when you get into some of the other aspects around health and safety, it goes more into that complex and chaotic area. Cost can be a key area. So if we want to push risk down, it costs more money. So if we're managing a bunch of risks, we may not have the resources to manage them all down to low levels. So cost can be a factor, and controllability. So we may not want to have appetite for risk, but we have to because the external environment is uncontrollable. We can't change the course of the election. All we can do is respond to it. We have to be open to the fact, if we tee up, if I order, that a whole earth may move beneath our feet if National are elected who have said that they will legislate them out. What is their role then? How could they then still achieve their purpose with that uncertainty? So I think having some of those discussions are really interesting, and you know, it's working out where you are on this, but most importantly, what are the drivers and explaining those drivers to staff, getting consensus between board and executive teams, which then creates consensus as a full foundation to risk appetite, given that you're giving clarity. We use this framework a lot, which is linked to it. It's a risk appetite framework as an Institute Director methodology. It's similar, but it helps to put labels on our risk appetite position. So we'll work through with boards for their top risks. We prefer to do it for actual risks, not categories of risks, and have conversations for each of those risks and work out where they are, and then think about, well, you know, if we're a really aspirational organisation and we're looking to get significant change, and yet all of our risk appetite settings are down at the averse and cautious end of the scale, that's going to be difficult for management to move forward. So is that balance right across the spectrum of risks? Health and safety will generally be down at this left-hand, but have we got enough up the other end of the scale if we're looking to be, you know, the leading digital organisation globally? You know, that takes uncertainty. We have to be up for that. So if you don't have a risk appetite yet, I would say it is something to definitely work through. And I think couching around that linkage to strategy and risk still encapsulates your compliance discussions. You know, if you're working through triple CFA, it's obviously material to the strategy if you're in the finance sector, because without it, you could lose your license. That's usually pretty catastrophic to your strategy. And therefore you think about, well, you know, can we manage that risk down? If we can, you know, what's our appetite for risk? Probably more cautious. But in terms of new products, that we've been more expensive, so you have a more balanced conversation between the two. One of the things I talked about was that VUCA and complexity, and I have raised this at these forums before, so excuse me if I've talked about it a little bit, but it is something that we now use on all of our risk discussions, and it's this concept of interconnectivity of risk. So this diagram on the left shows, you know, the traditional likelihood and impact ratings of risks, and it generally assumes that, you know, risks are mutually exclusive. We think about COVID as a risk. We rate it, well, people could get sick, it could have a bit of impact on our operations. Therefore, it's here on the likelihood and impact. But you know what happened when COVID struck? Well, it impacted our economy, impacted our supply chains, impacted the global economy, it impacted our people, impacted our third parties, impacted our health and safety profiles because people were working from home. So this one risk, which was perhaps COVID here, suddenly impacted all the other risks on the network. And for some organisations, that was catastrophic. Similarly with Fonterra, with their food safety, China closed the border to New Zealand products. There were supply chain issues. There was an investigation by the government. Their major customer didn't sued them for 191 million, and then built out their own supply chain to move away from Fonterra. So again, these catastrophic risks become because of the cumulative impact of multiple risks, not the impact of one risk being catastrophic. So, you know, how do we think about that with organisations? And so we take the most material risks as a starting point, and then we start thinking about, well, how do they connect? This is a diagram. I know it's a bit of an eyeful. Does it have a different note? Sorry. Bit of an eyeful, but this is for a council. So they've got risks around delivering what they've agreed to do around service delivery. So building stuff, libraries, bridges, roads. They then have, you know, key connections. So there's a line going from people, capacity and culture through to service delivery. If we don't have the right people, to engineers through to consenting people, it's going to be difficult to move those projects forward. There's a connection between those two risks. If we don't have issues around service delivery, there's going to be an impact on relationships. Our community are going to get really annoyed with us. Maybe we've got projects that will be problematic for parts of our community. So how do we manage those trade-offs? Similarly, climate change is coming in. What's the impact of that? Well, it's going to put pressure on our service delivery because we may have signed up to do we've got 3 waters. We need to do a whole range of work on those assets. And yet we also at the same time need to build resilience into our asset networks for climate change, weather adversity. So, you know, that's going to put pressure on service delivery. It may mean that we have to trade off other projects for climate change, which would have an impact on our relationships with our community. And a big line up to financial sustainability for the council because they have to take on more debt to do this work, perhaps put up rates. We've seen this with Auckland Council having to put up rates and sell things to be able to manage this multitude of things and priorities that they need to do. So, you know, you start to build this network up, and then you step back and you go, well, which are the risks that have the most lines in or out? They are the most connected risks. And you can see we've got service delivery. If we have issues with that, that impacts a number of different ranges of risks. It's also a receiver of risk. So it will be triggered off by a number of different risks. So in actual fact, when we think about likelihood impact, perhaps this is our most important risk, despite the fact it may have been further down our traditional scoring of risk. Relationships is a key receiver. So again, quite important. That is probably more likely to occur than we thought. But also, you know, if you step back, you go, well, look, you know, these risks don't operate in silos. They're all highly connected. Do our people understand this? Do the owners of these risks understand this? they get that if you're doing service delivery and you have a major problem, are you thinking about the flow-ons? So you're thinking about, well, that's going to push our climate change response off track. It's going to have an impact on mana whenua in our community. Are we happy about that? So it can really change the dynamic. And you know, when you talk with boards around this, it can show, well, actually, perhaps legislative compliance, which none of you particularly like to talk about, but look how key it is. If we don't do it, there's connections all over the place to your strategic risks. So yes, you may not want to talk about CCCFA, but if we don't, we can have major issues perhaps with our funders, with our customers, with policy from government, etc. So thinking about those connections. Where we are really starting to think about interconnectivity is around risk appetite. And if we headed back to this type of framework, one of those lines is around trade-offs. And what we actually are working through now is, you know, with all these connections between the risks, it identifies potential paradoxes or dilemmas between competing risks. And how do we deal with that from a risk appetite point of view? So the example is between, say, service delivery and relationships and climate change. So we need to, as a council, we need to do something on climate change. But actually there's a potential dilemma around how do we do all the other things we've committed to our community on, libraries and pools, all that kind of stuff. And also there are parts of the community that like this and parts that don't. So what does that mean from a risk appetite point of view? Well, do we have risk appetite to upset portions or our whole community if they don't support our ability to move forward on climate change? Are we willing to take risk from relationships, or are we going to sweat climate change? And actually we're going to sit on climate change, we're going to understand it, we're going to risk assess it, but actually we're not going to commit any money to it because we're not willing to take that trade-off. And this is where it becomes really interesting with executives and boards, because these are the trade-offs that the executives are having to deal with, but often the boards aren't thinking about the tensions and paradoxes between multiple risks. How do we manage the financial sustainability? Do we have appetite for changes to rates that could, again, exacerbate our relationship risk to be able to meet both our commitments in the long-term plan and the fact that we have to manage climate change? How do we manage the fact that policy change in government will completely push people's focus away from some of these core areas into how we're dealing with the change to three waters or to other local government legislative change? So we find that it really helps to broaden out the conversation on risk appetite and get into some of the harder areas rather than just saying, well, we have low appetite for health and safety. Okay, but are there areas you're willing to take more risk around health and safety by engaging with the community, getting volunteers? Yes, we don't want to take much risk around climate change, but actually we have no choice because we can't afford it and we're not willing to put up rates in our community in the face of economic headwinds, which makes it difficult for them to meet those commitments. Therefore, that's our risk appetite. So, you know, I do find getting back to the key points is even if you're dealing with operational risks, the connection between strategy and risk really helps to open up the conversation. It helps to give the sense to executive and boards that we're willing, we're supportive, and we're a bit more broad-minded around balancing both upside and downside risks. And I think having worked through risk appetite for the last 9 or 10 years, getting it into a place where it's quite meaningful and having some really good, robust discussions. And look, often the mandate then gets picked up by the executive to move it forward rather than it being a board-led mandate, which is heads to that point around the engagement of executive teams. So that was all I wanted to cover. Any questions or comments?
So where have you seen, I mean, you've been in the business for a long time, so where's the biggest sort of growth you've seen at a board level at the risk sort of area? Where's the biggest maturity shift at a board level?
Yeah, look, I think COVID pushed boards to really start pushing up the dial, because post-COVID, you know, I couldn't really think of any organisation that wasn't going through some form of digital transformation or pivot to their strategy in a big way. So, you know, I think when that happens, where you've got these static business models, the risk profiles don't particularly change that much. But it did feel like things had moved significantly during COVID and post-COVID, and therefore it suddenly became a very essential discussion to be had around understanding not just strategy and how we're going to deliver it, but the underpins to strategy being risk and how we're managing those risks. So I think we've definitely seen an uplift in boards and executive teams wanting to engage more on it, but try and reposition it out of just compliance and operational risks into more strategic discussions. But often I think there's struggling as to how to do that. And we do often see, you know, a strategic risk register and then an operational risk register, rather than going, well, actually think of it as a tip of the iceberg, and you know, you'll have strategic risks, well, risks to and from the strategy, which then will break open, but thinking about it more holistically rather than from a siloed point of view. We do find the interconnectivity boards like it because it's not too crazy, but it is their natural way of thinking about how risks move together and how they're managing, thinking about risks as levers. I guess that, you know, one thing from setting strategy, this does help if we're setting strategy to be thinking of what's the ensuing risk profile that will leave with us. If I put pressure on climate change, we'll put more focus on the strategy on climate change. What's the pressure points that result from that strategic discussion? Because obviously every strategic choice has a potentially different risk profile that leads from it. So, and that might be stepping into opportunity. It might be becoming more of a defensive mode, and it will change that risk profile quite substantially.
We've got an online question.
Yeah.
Once you've identified your black swan, grey rhino, silver linings, where do you take the conversation with management? Yeah,
well, I think putting in the context of strategy, so I mean, this is all good discussion stuff, but you know, we do say it needs to lead to action. And you know, I think the worst case scenario is we have a lovely discussion for 2 or 3 hours, and that's the end of it. So where it goes through from here is how do we convert this into action, and that will be thinking about, okay, we've talked about the risks, we've talked about drivers for risk appetite. How do we operationalise that in terms of if we're saying that risk is here and we want to bring it down, how is that going to happen? How are we going to govern across that? How's the exec going to monitor it? I think the good thing with this model is if you're thinking about risks inherently from both sides of the coin, effectively this is what the board and executives should spend all their time on, because it covers both strategy, performance and risk. So if you are saying, well, work through and identify the top 10 to 12 risks, set appetite for them, if the board's not talking about these risks across its work plan, then there's a governance gap. So I think that's a key thing to reflect on, is that the discussion identify areas where we're not doing enough work. And then secondly, how do we calibrate our strategies, our business plans, our budgets to support where we need to bring risk down? And because it's more than just downside risk, it's more balanced discussion rather than just what we need. Why is risk driving this organisation? Well, it's not. Strategy and risk are driving the organisation.
I had a question for you on your appetite framework. So then once they've decided if they're neutral or cautious or adverse, do you then match that to how they've rated the risk?
Yeah.
Because I mean, I can just see that a lot of people want to be, they'll say, yeah, we're adverse or we're cautious, but the risk will be in the neutral space, and it's very hard without spending a lot of money to get it down further, you know. So how do you balance that? Because they'll go, oh yeah, we want to be cautious, it's really important, but really they're probably with all their controls sitting at neutral and don't really want to. It's going to be very hard to get it down further.
Yeah, it's a great point. So what we do, we select the setting that we're on, and then we think about what does that mean in terms of residual risk? What's the target? I think in the early days we tried to directly tie this into the heat map, you know, the colour gradients. Didn't work particularly that well. So now we do a two-step. We say, well, okay, we are averse. What does that mean for residual risk target versus where we currently sit? But that's those tensions around, okay, well, the board have said we want to be averse. What does that mean against our residual risk? how feasible can we close that delta? What's the cost impacts? And actually, that's the value of the conversation. If management are going, by putting it to a verse, I'm going to need to spend millions on my asset network to build resilience. Are you happy with that? That is where the tension and the consensus comes between the two. That's the rub. So if the board is setting overly cautious risk appetite settings that have no bearance to, okay, for cyber, you've said you've got adverse appetite for cyber, and yet you've given me I've got no money to invest in my systems. I've got tech overhang of systems that are really old. Well, that's obviously not the case, and that's why I do like to have management in the room at the same time we do this with board, because it's management who go, this is all good talk, but the reality is we don't have enough money to solve our technology cyber risks when we're already trying to do all these other things at the same time. And that's where we really need to get into that discussion to nut out, well, does that mean that actually we need to have more appetite for risk and push up the setting? We're doing being too risk averse on the residual risk setting. I do often see residual risks being black hatted and people getting stuck on, it's always going to be catastrophic and rare, whereas I'm not sure that's quite correct. But yeah, Suzanne, that's the actual value of the conversation, is to try and identify those mismatches, because that's where you really get into the value of the conversation.
Another online question. Do you have a view on more quantified risk appetites and how they may relate to this type of framework?
Yeah, look, I said at the start, I feel like risk for me is becoming more judgmental and qualitative rather than quantitative. I'm wary of quantification. The whole reason this interconnectivity model was developed globally by KPMG and is now being used by the World Economic Forum was because the mathematical models to quantify and forecast risk can't encapsulate this complexity. I do agree with trying to get some measures around risk appetite. So if we can go through and say, well, for cyber, as an example, we've got an adverse risk appetite. If we can get some quantification in terms of measures to give us more data points around what's happening with this risk moving forward, perhaps limits. But I would say be careful with limits if you've never used risk appetite before. I think the banks have got risk limits, so that's effectively you've got a measure and you've got an upper level and a lower level that you can work within. If you go above the limit, it's obviously outside of appetite. But outside of the banks, insurers, risk resource really falls off a cliff. So I think as a first step for risk appetite, I would be more focused on having good conversations, getting consensus between board and executive, and then communicate that out to the organisation so people understand it, rather than my first step being to try and quantify it with measures to track. I would see that as steps 2 or 3, but we are fast tracking, identifying measures for some organisations so it can inform their quarterly monitoring of risks. So I would just be careful. Sometimes I've seen it happen and we've actually pulled the targets out because they were meaningless. There was no track record to understand how that limit related to risk appetite. It was just an arbitrary number. So what's the value of it?
Hi, thanks, David. Have you had any success of that next step after all of this work to say the risk program that we've been running has delivered X value to the organisation?
Don't think we've ever measured it, but I think in terms of engagement with the exec, in terms of actually calibrating mitigation plans and strategies to appetite, yeah, we've definitely had success there. And I've had certainly had a key success around interconnectivity and unlocking the fact that a risk is more important than envisaged, which led to an action plan which actually was a major strategic advantage to that business going forward. Management team were like, interconnectivity was the core reason for that, which was pretty cool from my point of view, very rewarding.
Look, thank you for those questions, and thank you for the questions online. David, a couple of things I guess resonated with me. One is the interconnectivity between the risk and strategy, that integration. I think that's crucial. It's good to see risk appetite being discussed in quite a qualitative way at a board level, because I think that's at a level that equates. And I'm loving this interconnect, if I can pronounce it correctly, interconnectivity between the risks, because I think we're all sort of used to a very traditional risk register, and and I think the example of COVID was just a classic of where they all entwined, and we had some real impacts from it. So, look, thank you for your insights today. So, can everyone join me, please, in thanking David?